Hi everyone and welcome to Swissquote's Daily Market Talk. It's Monday, 8th of June. Technology stocks are facing their first meaningful test in months as a combination of rising yields, some profit taking, and growing questions about AI spending pressured the sector since Friday. Unsurprisingly, memory chip makers are being hit particularly hard since then. At the same time, it is said that some investors out there may be freeing up some cash ahead of the highly anticipated SpaceX IPO that's due later this week. So the key question now is whether this is a healthy correction, a rotation to the next hot trade, or the start of a deeper revaluation. So we will talk about all that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
Okay, it may be happening. Correction in some hot pockets of the AI trade are giving signs of giving in since last Friday on a set of different factors. First, there's the US jobs data that came in last Friday, stronger than expected by analysts. I would actually expect a stronger than expected read in terms of jobs figures in the US, combined with a relatively soft wages growth to echo not that badly across risk assets in a setup where rising inflation expectations make a Federal Reserve rate hike increasingly likely. So expectedly, the strong US job additions sent the US 2-year yield to 4.20% level from around 4% before the data was released on Friday, but the latter hit the global stocks pretty hard actually, harder than I thought, starting with the technology names. The thinking was that the rise in borrowing costs would reduce the present value of future earnings and can weigh on investment spending. But not only, because rising inflation expectations and rising borrowing costs have been in place since a while now without necessarily bothering technology investors, meaning that a strong jobs data released on Friday was not only responsible for Nasdaq's nearly 5% slump on Friday's trading session. And to give a broader context, VanEck semiconductor ETF sold off more than 9% on Friday. Micron, which has become the bellwether of the latest chip rally, tanked 13%, and the Korean Kospi Index, which is shouldered by two memory chip makers there, Samsung and SK Hynix, is down by more than 5% this morning. At the time I'm talking here, it again halted trading today, but this time because it was being sold too aggressively. So back to why. Why the bloodbath that we saw on Friday across technology is not only due to a stronger jobs data, but as I discussed on Friday, there are rumors right now that investors who surfed the chip wave would be tempted to take their profits, free up some cash to jump on the SpaceX IPO that's due later this week. That could be one of the reasons that exacerbated the sell-off that we saw across the chip makers. But more fundamentally and more importantly, two major news actually justify the hefty slump that we saw across chip stocks since last week and threaten to deepen losses. One, a report from Nvidia suggesting that its next generation Vera Rubin platform would use far less DRAM memory than previously expected. Remember, this was one of the risks that I was pointing at in my May 27th report, that new chip infrastructure, among other technology advances in the sector, could eventually come and decrease need for DRAM and weigh on memory chip makers' profit expectations. So Friday's news from Nvidia just did that. It suggested that their new technology would need less memory to function. And second, Anthropic released a report calling for safeguards that could slow or temporarily halt frontier AI development, raising concerns that spending on AI infrastructure may also lose some momentum. So the latter two, combined with stronger than expected jobs data from the US and Broadcom's cautious revenue outlook for its AI chip, have taken a fair amount of air out of the balloon since last Friday. It's now to be seen whether this downside correction would continue or whether the buyers would already take the opportunity to jump back in. Obviously, given the strength and the size of the rally over the past few months, a deeper downside correction in technology would be needed to bring valuations back to healthier and more fundamentally meaningful levels. But the AI hype and the future expectations have gone so out of control that dreaming is part of the pricing game today, and there is no certainty that we will actually see this downside correction get deeper. But let's see. For those who still like to look at the numbers and try to understand whether the valuations make sense, take Micron as an example. The company's trailing PE ratio has climbed about 40 times. That's around 143% above the 10-year median of 16.8 times. All else equal, the stock would need to fall below the $400 per share to return to its historical average valuation based on trailing earnings. Now, of course, such a comparison ignores completely the significant earnings growth expected from the AI-driven surge in memory demand, because in fact, Micron's forward PE ratio now stands near 8.5 times, suggesting that analysts expect profits to rise sharply in the coming quarters due to the AI demand. As a result, a return to historical valuation multiples does not necessarily require a collapse toward the $400 per share. But if AI needs slow due to technology advances and or slower adoption, we could see investor enthusiasm cool down and pull Micron lower. Price-wise, I would say that a pullback to $700 per share level would relieve some of the pressure without necessarily damaging the medium-term positive trend in Micron's stock price. Now, broadly speaking, the good news is that US futures don't suggest an ugly start to the new week. Despite the Asian technology sell-off this morning, Nasdaq futures are actually in the positive territory at the time I'm talking here. So we are just before the European Open. But for European indices, it is quite another story, unfortunately, because the STOXX futures are down by more than 1% right now. And that's basically due to the rising oil prices this morning. And for the US, well, sentiment remains quite fragile due to the geopolitical concerns around Middle East, higher energy prices as a result of it, and the rising yields this morning. So there are many factors in play right now into a big week in terms of geopolitical news flows, economic data, and the SpaceX IPO. So I would say that despite the early positiveness across the US futures, risk here also look two-sided. So speaking of geopolitical news, the Middle East ceasefire looks increasingly fragile with parties attacking each other. So I wouldn't even call this a ceasefire anymore. Nobody's actually ceasing fire. As a result, crude oil is up by 4% this morning, fanning inflation expectations across the globe and pressuring yields higher. Speaking of economic data, last week's CPI report showed that the higher energy prices sent European inflation above the 3% mark last month and slowed growth as well. The euro area GDP contracted 0.2% in the first quarter of this year versus a meager 0.1% expansion expected by analysts. The latter, combined with Friday's stronger than expected US jobs data, pushed the euro dollar under a buzz. The pair is now flirting with the 115 support to the downside, with room for further weakness on the back of a more hawkish shift in Federal Reserve expectations versus pretty much the same thing for the European Central Bank, meaning a rate hike in the next meeting and maybe one or more 2 rate hikes due in the second half of this year, depending on the inflationary pressures, of course, which itself depends on the Middle East tensions. But before going that far, on Wednesday this week, the US will unveil its latest inflation data, and the US headline inflation in May is expected to have climbed to 4.2% level due to higher energy prices due to the Middle East war. So that's twice as much as the Fed's 2% policy target and even more. So a figure above the 4% mark would clearly grant a rate hike into this fall in the US, and activity on Fed funds futures now assesses nearly 60% chance for an October rate hike. And obviously the same bullish move in the US dollar and Fed expectations is pressuring the dollar yen above the 160 level, with growing unease from the Japanese officials in the air, obviously, but no intervention just yet. At the current levels, the potential for a further upside in the dollar yen still looks increasingly limited. The question here is whether there will be an intervention from the Japanese authorities or a rate hike to stop the yen's bleeding later this month, or both. For short-term positions, the question is just simpler than that, whether we could see the dollar yen come down sharply another round or no. And finally, speaking of SpaceX IPO, well, SpaceX is expected to price its IPO on June 11th and begin trading on June 12th, making this week a key test of investor appetite for the largest IPO of all times. Interestingly, trading in Hyperliquid, which is a decentralized crypto exchange where traders can actually speculate on assets such as SpaceX through synthetic contracts, points at a more than 20% decline in SpaceX USDC contracts since the beginning of June, hinting at some cooling in speculative enthusiasm ahead of the SpaceX IPO, although it is not a reliable indicator of actual investor demand for the SpaceX listing later this week. The real test will be on Friday, and I can't wait. But this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.